All right, so we've been getting some questions as far as why should I practice the infinite banking concept? Or why should I even take out a cash value life insurance policy? Got any answers, Sam?
Nope.
All right, so we're going to go through a couple bullet points here. What is the first one we have there?
Tax-free.
Tax-free, right? So when it comes to taxes, and this is not so much the concept, right? This has to do with cash value life insurance. That if, key word here, we're going to put this in big print. If everything is set up properly, we can use the policy tax-free. It'll function similar to a Roth account. Now, there are ways that we can abuse it and run into trouble from a taxable standpoint. A couple things are as follows. One, we don't need to spend much time on this, is the whole idea of the MEC. Right? If we trigger a modified endowment contract, that's going to ruin the plan, and it will function very similar to a 401k. Tax deferred, but if we access it, we've got to pay taxes, penalties, not attractive. We got other videos on that. A couple other pieces that if we have a non-MEC, an ordinary life insurance policy, and I pay in, we're going to call this my cost basis. Pardon my handwriting here, Cheyenne. If I pay in $100,000, and let's pretend that my cash value has accumulated, how much money we want here? You want $1 million? I'd like $1 million too. Let's say it's grown to $250,000 over any period of time, right? So that means I paid in 100, I have 250. This is a non-MEC traditional cash value life insurance policy, exactly what we want. And I decide that I'm going to cash out. The terminology the insurance company will use for this will be surrender. Right, if I cash out my life insurance policy, I get a check for $250K. What's going to happen is the IRS is going to recognize that as a taxable gain, and I have to pay taxes on the gains, which will be the difference, $150,000. So obviously, we don't want to do that. However, it is very important to be aware of, because how is this concept and product often marketed? Tax-free, tax-free, tax-free. Yeah, if you do everything right, it's tax-free, but we can run into issues. Other pieces on taxes. So let's take that same scenario. Right, we'll assume our cost basis, what we paid in, is the same 100K. We'll assume our cash value is the same 250K. There are two ways which you can get money out of a policy. We'll go through this in more detail on another segment, but the two methods are policy withdrawals and loans. If we withdraw money from a policy, it can no longer earn interest. Also, if we withdraw more than what we paid in, guess what happens? We have to pay taxes on the gains, just like what we would have to if we cashed it out. So if you paid in 100, you withdrew, you didn't lapse it, you just took out, let's say 150, what's going to happen is the IRS will recognize that you only paid in 100, you pulled out 150 in withdrawals, so you're going to be taxed on the 50K gain. To bypass that or avoid taxes altogether, you never want to withdraw more than your cost basis. You may have heard this before. When we're looking at a policy purely for income, we'll often withdraw up to the basis and then loan out the rest. That's how we keep one of our favorite terms here, right? Which is what we want. What do we got next?
Keep earning interest even when taking out a loan.
Keep earning interest even while taking out a loan, right? So this really focuses on the concept, why don't we do this? I got an idea here. We're going to pull up a quick example that we've used in prior segments. We'll just touch on it very quickly. Right, so we've got it entitled, How Policy Loans Work. If you look at our intro video just on the banking concept, this touches on it as well. Main point, right? My money stays at work for me even though I have a loan outstanding. How does the screen size look? Big enough? A little bigger? A little bigger? All right, so what we have here, we'll just focus on the left first, is a 45-year-old male. At the end of the first year, he's 46, pays in $50K a year for 10 years. His dividend column, here's his growth, right? Breaking even between years 3 and 4. This one just shows I put money in, let it sit and grow. Okay, that's great. Let's compare this to the exact same scenario, but when we borrow and repay, right? So, the main question, when I take out a loan, what happens to my money? The answer is I continue to earn interest on it as if I never pulled anything out in the first place. Right? If I own a home and my home is appreciating by 5% every single year, if I have a line of credit outstanding, if I have a mortgage outstanding, does not matter, I still get that same 5%. Same exact thing here. How the company does that, I pull out $200K, death benefit is collateralized. We'll go back to the other example. The other one was 1.6, here it's 1.4. Cash value is my line of credit. Let's shrink this down just so we can compare and contrast here. Get them side by side. Oops. There we go. So let's just do this. I need to zoom in here a little bit, let me know. Year 10, cash value is $570,000, death benefits 1.958. Over here, I took that $200K loan out, paid it back quickly. Doesn't matter when I pay it back. When it is paid back, I'm going to see this effect. Everything's fully restored. Point again being, when I borrow out, yes, I pay interest to the insurance company, but I keep receiving interest forever. What do we got next? Flexible. I love this one. Right, so when I hear insurance policy, what often comes to mind is payments, premiums, forever. I pay the same amount every month, every year. It's very boring. Right? When it comes to this concept, it's the opposite. Right? We can design a policy where it's extremely flexible. Right? So if I'm paying in, right, $5,000 a year, let's say that that is my premium. Does that mean I'm locked into that payment forever? No. Right? If I want to stop in 4 or 5 years, I can do that, provided it's set up right. Let's say I set my MEC limit here. This is the maximum I can pay in per year at $50,000. Right? So what this means, I'm going to commit to 5. I've got the ability to pay in 50. Commit to the minimum, add more at my discretion. So this means literally, and we have a lot of people that do this, they commit to 5. At your leisure, if you have a good quarter, a good month, hey, I got an extra $20K I want to throw in there, guess what? I can just add it in. Depends on the company and flexibility provisions, of course, which we've got more on that in other segments, but I just dump it right into the account, into my PUA piece. Depending on the company, it could be as easy as logging on an online account and hitting deposit. Same thing when I throw money or pull money out via loans, repayments can be very simple, all a hands-on approach, which is what we want. Does that help on flexibility? Anything I'm missing? That's good. We can stop in 4 or 5 years if we want to. All right, what do we got next?
You have control.
You have control, right. So this is in the sense of your payments, right? We've done a past video, what if life happens, right? I can't pay anything in anymore. Am I locked into it? Am I in trouble? The answer is no. If it's set up right, I can stop payments altogether. We just touched on flexibility. I can adjust them up and down. The other big thing, really with the word control, is that you have complete control or access to your money. right? Meaning with a life insurance policy, if you've built up $10,000 in cash value, $1 million in cash, whatever amount, and you want to pull some of it out, you don't have to ask your broker or anyone, hey, can I get my money? No, you can call them up and they can process it for you. You can also log onto your online account. You can mail in a request. You can call it in. It's very simple. You're in control of paying money in. You're in control of taking money out. Loans, repayments, dumping funds in. It's very flexible. You don't have any loopholes or such to jump through, provided, again, it's set up properly. What do we got next?
Guaranteed dividend.
Guaranteed rates and dividends. All right. So, how many videos have we mentioned 4 major mutual companies? Like, I don't know, all of them, right? So, when we take insurance companies, there's a lot of them out there, obviously, right? And then you have what are considered your 4 major mutual companies. Simple reason to this. When you take the big 4, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, there is proof of performance. We have it from old policies. They've delivered the highest returns. Other companies won't show it. You can also see it in their guaranteed values. And when you look at major banks and corporations, they're primarily using these companies because they deliver. You've got 2 elements, right? And this is with the big companies. Here's an example of Guardian. This is also with small companies. Most of them will have this as well. Right, when we look at a policy, we have a guaranteed cash value interest rate. Is that small?
Yes.
Blow it up. All right, thanks. That better? All right. So we got to update this to 2019. I can't believe it's April already. My goodness. So we have a guaranteed rate of 4%. What that is the minimum interest rate they'll pay. That's the floor. In a worst case scenario, they're not going to pay any lower than that. Then we have the total dividend interest rate over here. So does this mean I get both? No. What it means is the company had their basic guaranteed rate of 4%, and they declared a surplus in their earnings. After they covered all of their insurance claims, expenses, paid employees, the whole 9 yards, they had a surplus in earnings, which in this case, this is Guardian, was 1.85. Take the surplus plus the guarantee, gives you the total dividend interest rate. It's largely based off of where they invest as a company as well. So, dividends are important. When we look at companies historically, we want to look at a bit more. We want to look at the actual returns. Who's paid the highest, not just shown a great dividend. That's the key. But you will see a consistency with the major mutual companies. Have always paid solid dividends. We keep going here. See that guarantees at 4%. All right, going back to the 80s. Higher interest rates. Double digits, man. That'd be nice to have this in a policy. Here's Mass Mutual. That's small, Cheyenne. That's good. All right, so same thing with the guaranteed rate of 4%. Here's what we want to emphasize. This one dates back to 78 in this sheet, 7.4%. Scroll down to current. All right, you're at 6.4. Total dividend rate is a combination of the guarantee plus the surplus. What do we got next? That's it. We're done for today.